morning, everyone. My name is Corey Diaz, and I'm the CEO of Anfield Energy. Anfield trades on the TSX Venture under the ticker AEC and on the QB under ANLDF. I'm here to talk about the company. We are a company with all of our assets in the US, and our plan is to get into near-term production of both uranium and vanadium. Safe harbor, read at your leisure. Capital markets profile. Current market cap is roughly 81 million. Our largest shareholder is Encore Energy, a uranium producer based in the US. We also have UEC as a major shareholder of the company. We have a target price from Red Cloud of 20 cents, and a 12-month target price. So reasons to invest in Anfield. I'm not sure how many know this story, but we're a hard rock story in the US. We have a large portfolio of conventional uranium assets underpinned by the Shooting Canyon Mill. The mill is one of only 3 licensed, permitted, and constructed conventional uranium mills in the United States. We're strategically located within one of the most historically prolific production areas for uranium in the United States. So we have assets in Utah, Colorado, New Mexico, Arizona. We've got a mix of current and historic resource. We're not a greenfield story. We don't look for greenfield assets and look to drill out. We actually look for established resource, whether it's historic, current, or there's past production at site. We acquired the Slick Rock project in Colorado, which is one of our significant projects for near-term production, from UEC back in 2022. And then we've also acquired, more recently, the Marquez 1-4 project in New Mexico, our first entree into that state, with an aim for secondary production, longer-term production. I'm sure you've been hearing a lot about the inherent risks in the sector. Just a few points I wanted to touch on. A lot of geopolitical risk inherent in the sector. Obviously, Russia and Ukraine is causing some issues related to supply chain. China is obviously becoming a major player in the sector. Kazakhstan and China are getting a lot closer, which means a lot of the pounds that would tend to come west are now going east. Niger, there was a coup which disrupted Iranian's production there, and there's some export controls which are affecting material leaving that country. And then the US, we're looking at production. The US is the largest installed base of nuclear reactors, and yet produced about 12,000 pounds of material in Q4. The US uses between 45 and 50 million pounds per year, so clearly is dependent on outside sources, which is a risk to those reactors. Lots of opportunities in the sector. Nuclear renaissance has been bandied about. I agree. China's building out, UAE, India, Eastern Europe. Japan is restarting some of its reactors that had never expected to be started again, and also looking to extend the life of a lot of those reactors. The US has put together a 200 gigawatt roadmap, potentially tripling the amount of uranium that could be produced in the US. And then finally, the government over the past few years has put together a uranium reserve program to acquire pounds. And the pounds that were acquired last year were acquired at about 20% above the spot price at the time. So you can see there's a premium being built for US related production. Supply, once again, remains an issue. Cameco missed its numbers, has guided down last year, and there's some risk related to what its numbers will look like this year. Cameco is going back into the spot market, which implies that it won't have enough production to meet its demand. Physical uranium trusts like Sput, Yellowcake, continue to buy pounds out of the spot market, which means there's less left for utilities. Kazatomprom also missed its production numbers and is expected to miss again this year's 2024 production numbers. And then recently there was a non-US utility seeking 21 million pounds in a 15-year contract, which is unprecedented. Once again, I think that there are some utilities understanding the inherent risk in the sector, trying to secure supply at whatever price it can at this time. So with demand increasing and supply dwindling, it's the perfect time to be in the market, and we're in the largest installed base market when it comes to pounds, and so we think there's a massive opportunity for us to be selling into the US market. In terms of the assets that we hold, our plan for production is based on a hub and spoke strategy. So the mill itself serves as the hub. Our mines will serve as the spokes. You can see in the top right picture, the gray dot represents the Shooting Canyon Mill, And Velvetwood and Slick Rock are represented by slightly darker blue dots, and those are the first 2 mines which will go into production. We did put out a PEA related to these 3 assets, which returned an NPV of roughly $238 million at a $70 uranium price. So given where the uranium price is today, we'd expect to see those economics improve. So core assets, Shearing Canyon Mill, as I mentioned to you, we acquired this mill back in 2015 from Ross Adams' U.S. partner, which was Uranium One. It's a 750 ton per day mill, so it's the smallest of the 3 mills in existence in the U.S. We're actually working on increasing the throughput at the mill to 1,000 tons a day. We're working with the state of Utah in that regard. When we acquired the mill, we also acquired the Velvetwood Project. Has historic resource. It also has historic production, 4 million pounds of uranium, 5 million pounds of vanadium. And this was also included as part of the PEA that I mentioned. The Westlope Project, we acquired this in 2018 from Cotter Corporation, which is owned by General Atomics, a weapons defense manufacturer out of San Diego. We have these are 9 DOE leases with past production, most recently in 2006. There's a historic resource, or a recent resource, of 5.4 million pounds of uranium, 27 million pounds of vanadium, and then a historic resource of roughly 4 million pounds of uranium and 20 million pounds of vanadium. So you can see these mines are essentially vanadium mines with uranium in them. And our plan is to actually produce the vanadium and sell it when the market price justify us selling it. And then finally, the Slick Rock project that I mentioned that we acquired through an asset swap with UBC. This has past production and a resource of about 8 million pounds of uranium and about 47 million pounds of vanadium. This serves as part of our hub and spoke strategy, near-term strategy, and served as part of the economics related to the PEA. The picture to the right shows you a close-up picture of the mill, and the bottom right picture shows it from a slight distance. The secondary pipeline acquisition, as I mentioned, we're creating not only a near-term pipeline for production related to Colorado and Utah, but we're also looking at secondary production coming out of New Mexico and Arizona. We think that Marquez Juan de Forest serves a purpose as the core asset for our secondary production. We acquired it back in 2023 from Encore. 18 million pounds of resource. It's our largest single uranium resource within the portfolio. It has a historic PEA. Roughly NPV of $21 million at a $60 per pound uranium price. So obviously with the economics at $60, if we're looking at $80 to $90, those economics should improve significantly. So Anfield steps to production. As I mentioned, our near-term plan is tied to Sheetering, Velvetwood, and Slick Rock. We've engaged an engineering firm called PSE to outline the mill reactivation plan. We actually plan to submit our application for restart to the state of Utah by the end of this month. We're actually, within that application, we're looking to increase the throughput, as I mentioned, from 750 tons per day to 1,000 tons per day. We're also looking to increase the license capacity at the mill from 1 million pounds per year to 3 million pounds per year. This also shows some of the results of the PEA. The NPV of $238 million US at a uranium price of $70 and a vanadium price of $12. We're also adding a vanadium circuit to the mill, which is part of the upgrade of the mill in order to capture the vanadium that's found in many of our mines. Our near-term plan includes the Westlope properties that I mentioned we acquired back in 2018 from Cotter. These are 9 DOE leases with historic production. Our plan is to add those into the mix when we start production. As it currently stands, Slick Rock would run for roughly 16 years of production. Velvetwood would run for about half that time, and we can slot Westlope in after Velvetwood is depleted. And then longer term, as I mentioned, Marquez Juan de Forest serves as the core asset in that regard. We do have assets in Arizona, which could also serve as part of the secondary production plan, because our aim here is to have production for 25 years or better. And once again, replace those pounds. We don't want to deplete it. As we produce, we want to replace. So we want to have 25 years of potential production within the portfolio at all times. So just a little bit more about the Velvetwood Projects. As I mentioned, we acquired it back in 2015 from Uranium One. Historic production, 4 million pounds of uranium and 5 million pounds of vanadium. Lots of infrastructure in place, very important. Grid power, water, 125 miles away from the mill. There's an existing decline there and a portal. And so we think this could be turned on relatively quickly. This mine, the aim is to have this mine up and ready within 18 months, so roughly 6 months ahead of the mill being ready for production. Westlow Projects, as I mentioned, acquired from Cotter Corporation. You can see the picture to the top right. That is JD8. That's one of the mines. You can see that there's still rail there. The adits are open. There's equipment within the mine itself. And it's the same for all of the mines that we've looked at and identified as ones for near-term production, all the JD mines, so JD 6 through 9. Our plan is to open these mines up once Velvetwood is depleted, but certainly if we increase capacity at the mill, there's an opportunity for us to fast-track the Westlow properties and start production even earlier from these mines. And then Slick Rock, as I mentioned, this is an asset we acquired through an asset swap through UEC. There's historic production back in the early 80s. There's infrastructure in place, once again, very important. Existing shafts, portals, workings at sites, road and power access, very important. The picture to the top right, the green shape represents the Slick Rock project. The other blue shapes represent DOE leases. We originally owned the top left DOE lease, but we've recently acquired the other two shown on this map. So you can see how close these lines are together, and it gives us opportunities to create economies of scale when we look to produce. So peer comparison, always my favorite slide. AEC is represented on the far left. The companies, the first 4 companies to the immediate right of AEC are companies with the ability to produce, i.e. having existing infrastructure, processing facilities that would allow them to produce uranium. So that's Energy Fuels, UBC, Encore, and UR Energy. You can see the market caps of those parties dwarf AEC's, despite the fact that Anfield also has a production facility, albeit it's about 24 months out from restart. But we think that, given where we are in terms of valuation, URE of the smallest of those 4 is roughly 7 times our market cap. I think that shows there's a real opportunity in terms of bridging that gap given our asset base. We think that we should trade roughly in line with or close to at least the smallest of our peers. Obviously, if you look on the higher end, those numbers are more than 40 times our valuation. But certainly, it gives you a sense as to what the potential upside could be when it comes to Anfield's valuation. Management directors, I'll ignore myself. I think importantly, Ken Mashinsky, someone who we brought on the board about 1.5 years ago. Ken is now our chairman. He's worked more than 30 years in the nuclear space. He was a vice president at Cotter Corporation and at General Atomics. He ran a facility down in Australia, producing 5 million pounds of uranium per year, Quasar Resources. He was on the management committee of Honeywell and General Atomics for Converdyne, so he understands the conversion side. He's actually helped to build reactors in UAE. So he has experience in a number of different areas that are important to us as we move forward to production. And just one other person, Don Falconer, 35 years of uranium-related experience. Both in uranium and nuclear facilities. So he's actually worked for OPG, so Ontario Power Generation and Nuclear Division, in the sales and marketing division. He's been on the board of Uranium One, Energy Fuels. He was the CEO of Oz American Mining. So he's got experience both as a CEO and sitting on boards of significant producers, and has also written contracts in the sales and marketing role when we're looking to secure contracts with utilities. These are just some other assets which are not core, but just give you a sense that we do have other assets within the portfolio that we acquired alongside the mill and Velvetwood back in 2015. And that's it.